Hello to everyone. I welcome you to my revision class for financial accounting. This is Senior Hannington, your accounting tutor. Now, in today's revision class, of course, we are going to look at single entry and incomplete records. I have a revision question here, which I'm going to use. This question is from Business Accounting 1 by Frank Hood. If you can get a copy of that book, you can find this question under the questions of single entry and incomplete records. And I've already shared this with most of the students. So I'll try to go through this, and then we see how can we come up with a complete set of financial statements from incomplete. Now we have this revision and the summaries of the cash book and the bank accounts of Jed Duncan, who does not keep his books using the double entry system. Of course, we have a bank summary as well as a cash summary. Remember, a cash book, if it's a two-column cash book, we have a column for cash as well as columns for bank. So we have our cash columns as well as the bank columns, both debit and credit. So here they have given us a summary of the cash book. So meaning that we have a summary of our cash book as well as a summary of bank accounts. So we start with the bank summary, where we have the opening balance, and our opening balance in this case, so that is our opening balance. Then we have receipts, and under receipts, of course, we have debtors, 26,000, as well as cash banked. Don't forget that this cash banked, this is a contra entry. Don't forget, whenever you bank cash, then that is what? That is a contra. So you expect to see this even in your cash book. That is the credit column of the cash book. Then in debtors, we received some checks received. These are likely to be checks. But we are looking at the bank summary. So this is received from credit customers. Checks received from credit customers. Remember, debtors, those are credit customers. So meaning that Duncan sold some goods to the customers on credit, and now some of these customers are paying Duncan by check. So you will see that the debit side of your cash book, bank column, will be debited with these checks received from the creditor. So we have 26,000. So that is a total of 30,100 on the receipt side of the cash book, bank column, giving us a total of 38,100. That is if you also add the opening balance of 8,000. Then the payment side of the bank account, we have trade creditors, meaning that these are check payments. Check payments to credit suppliers. You're paying some of your suppliers. You're using a check because this is in the bank account. So you paid 18,500. Then rent, that is 1,400. Machinery, 7,500. Don't forget that machinery, this is a non-current asset. So Duncan during the year purchased machinery, non-current assets. Don't forget, this is to be taken to the statement of financial position. And of course, we have to calculate depreciation. Then we have wages of 6,100. Then we also have what else? What else do we have in this case? We have insurance, which is 1,450. That is your insurance. Then in addition to the insurance, you have what? You have the data, dishonored checks. So you received some checks from your customers, but now some of the checks were dishonored, so you have to credit your bank account. Then loan interest. So Duncan has a loan, and of course, Duncan has to pay interest. So this is the interest which was paid by Duncan during that year, giving us a total payment of 35,500 and with a balance of 2,600. Remember, to get this balance, we are getting our total receipts and the opening balance, which is 38,100 minus 500 to come up with a closing balance of 2006, come up with a closing balance of 2,600. So that is our bank summary. That is our bank summary. Let us look at the cash summary very fast, and then we'll see what we have in our cash summary. So the cash summary of Duncan, of course, we start with an opening balance. As you can see, we start with an opening balance at the start of the financial year. Then we have cash sales. So Duncan made sales, sold some goods, and of course received cash worth 14,000. Then we have debtors. Of course, now this represents cash that was received from the creditee customers. Cash received from credit customers. Duncan sold some goods on credit to the customers. Now some of the customers are paying Duncan cash, 400. So that is the debit side of your cash book, cash column. Then you also have the payments, the cash summary. We have some payments here for cash, drawings, repairs, electricity. Don't forget the cash that was banked. I told you that this is a contra. It appears in your bank summary as well as in your cash summary. So this is the contra entry. We already have this in our bank summary. That is 4,100, giving us a total payment. Total payments 14,650. Total receipts, that was 14,400. When you add the receipts plus the opening balance, you come up with 14,700. 14,700 minus the total payments, you come up with a balance of 50. So Duncan has a cash balance of 50 at the end of the year. 31st December. Of course, referred to 2008. The following referred to 2008. We have some bad debts that were written off. We have the discounts received. We have goods withdrawn by J. Duncan for own use. These are drawings, don't forget. These are drawings. Then you have credit notes issued, 1,200. Then in addition to that, you have some additional information there given. Let us also try to check on this additional information. And then we see what we have. Additional information. So they are telling us that the following additional information is available. So you have information 1st January 2008, as well as some information on 31st December 2008. These are opening values. This is start. We can use opening. Then these are closing at the end of the year. Closing end, closing stock end, your end balances. So you have stocks, you have the opening as well as the closing. Then we also have what? We also have the machinery, rent, prepaid. We have rent owing, debtors, creditors, loan from bank at 8%, and then the loan interest owing. What are we required to do? Calculate the value of J. Duncan's capital on 1st January 2008. Of course, when you look through this information we have, we don't have J. Duncan's capital as a start, but we are going to see how do you arrive at that opening capital. How do you arrive at the opening? How do you arrive at that opening capital? Then B, prepare the trading and profit and loss accounts for the year ended 31st December 2008 for Duncan. And then the other part is all about coming up with a statement of financial position as at 31st December 2008. Now, you see, we don't have capital as at the start of the year for Duncan, but we know very well that we can arrive at this capital by preparing what we call a statement of affairs. We talked about this in class, that we shall prepare what we call a statement of affairs. Statement of affairs. As at 1st January 2008. Now, this statement of affairs is always prepared to determine the opening capital. So we prepare the statement of affairs to determine the opening capital. Don't forget from your accounting equation. We know very well from the accounting equation that our assets equal to the liabilities plus owner's equity. So if we arrange this, it means that equity will equal to assets minus liabilities. So since we have prepared a statement of affairs as at 1st January 2008, I'll get the assets of Duncan, I minus the liabilities to arrive at Duncan's capital as at 1st January 2008. So we already have the opening balances here. Those are the balances as at 1st January 2008. So it's just a matter of knowing this is an asset, this is a liability. Stocks, these are assets, current assets. Don't forget, these are current assets. Machinery, these are non-current assets. Rent prepaid, this is a current asset. Rent owing, this is a current liability. But of course, we see at the start of the period, there is no opening balance for rent owing. There is nil. Then debtors, these are current assets. The debtors are current assets. Then the creditors, these are current liabilities. Loan from the bank at 8%, this is a non-current liability. Then we have rent owing. This is a current liability. And at the start of the period, we have nothing. So meaning that I'll just get the total assets, both current and non-current, then I minus the liabilities at the start of the period to come up with our opening capital as at 1st January 2008 for Duncan. So let's say we can prepare the statement of affairs, and then we determine Duncan's opening capital as at 1st January 2008. So I have this page. So we are going to come up with the Duncan's opening capital as at 1st January 2008. But of course, we prepare what we call a statement of affairs. We prepare a statement of affairs. So part A. Value of J. Duncan. Capital. Value of J. Duncan's capital as at 1st January 2008. So I'll say J. Duncan's statement of affairs as at 1st January 2008. So we have pounds. I will maintain the pounds. I'll come, we'll list our assets and just list the assets. You have the, let us classify. We have the non-current assets. And other non-current assets, of course, we have the machinery. And from our question, machinery is how much? Machinery is 12,600. Then from there, we go to the current assets. Under the current assets of Duncan, of course, you'll start with the opening balances of bank. Opening balance of bank, check your bank summary. There's an opening balance of 8,000, so you can start with that. It's an asset at the start. Then there is also cash opening balance, which is 300. Check the question, please, 300. Then we have our stock, the opening stock from the additional information given there. You have 4,100. 4,100. Then what else do we have? We have the rent prepaid. Opening balance of rent prepaid. That is how much? That is 200. Rent prepaid is 200. Then you have the debtors still under that information, the additional information. Your data as you have 6,300. When we add these current assets, let me do the addition here and we see how much we have. Let me try to do some addition here. 8,000 plus 300 plus 4,100 plus 200 plus 6,300. This gives us 18,900. Of course, here I'll get my total assets as how much? 12,600 plus 18,900. That gives us 31,500. 31,500. So that is your total assets figure, both current and non-current. Then I'll say equity. Now, this statement of affairs is like a balance sheet, an opening balance sheet, equity and liabilities. So I have my capital as at 1st Jan 2008, which we don't have. Then I have a non-current liability. I'm treating this loan, non-current liabilities, loan. I'm treating it as a non-current liability. And this is how much? Our loan is 5,000. Then you have the current liabilities. And under our current liabilities, the only current liability we have at the start, those are the creditors. So the creditors, and the creditors balance is 5,000. But remember, when you add your equity and liabilities, you get, this is total equity and liabilities. Your total equity and liabilities should equal the total assets figure, which is 31,500, which is 31,500. So our total equity and liabilities should equal to 31,500. However, when you look at the equity and the liabilities, you'll find that you cannot get 35,100 because for the liabilities, so far you have a creditor of 5,000, you have creditors of 5,000, then you also have a loan of how much? No, creditors are 2,400 according to the question. This is 2,400. This is 2,400 for the creditors. From the question, you have 2,400. So when you add your equity plus the liabilities, you should get 35,100. But of course, we cannot get that because we only have creditors of 2,400 as well as a loan of 5, as well as a loan of 5,000, meaning that your equity is going to be your balancing figure. This is balancing figure. So when you try to balance out, you'll find that your equity is 24,100. This is J. Duncan's value of capital as at the start of the period. So J. Duncan's value of capital is 2004, is 2000, sorry, it is 24,100, and this is our balancing figure in this statement of affairs. In this statement of affairs. So to come up with that 24,100, this is what we have, this is the approach we have used. I'm still getting my say capital. I'm getting my total assets minus liabilities at start. Total assets, you have 35,100 pounds minus total liabilities, you have a 2,400 for the creditors plus a loan of 5,000. When you get this minus this, of course, you come up with your capital of 24,100. So that is Duncan's capital as at 1st January 2008. That is our capital as at 1st January 2008 for Duncan. So that's it. When I take you back to the question, we need to see the next part of the question, and then we move on. So part B of the question, prepare the trading and profit and loss accounts for the year ended when? For the year ended 31st December 2008. For the year ended 31st December 2008. So they want you to come up with Duncan's statement of profit and loss for the ending 31st December 2008, or simply the trading profit and loss account for the year ending 31st December 2008. Let us see how we can come up with this. The good thing, most of our information is direct, so we can see how we can get how we can come up with a statement of profit and loss, or the trading profit and loss account for Duncan. Okay, let us see how we can do this. So on my next page, we want to come up with a statement of profit and loss for Duncan. This is part B. I'll say Duncan, that is J. Duncan. J. Duncan is statement profit or loss for the year ended 31st December 2008. For the 31st December 2008. Yep. 31st December. I'm going to still use 2 columns. Just want to divide this sheet into 2 columns, 2 parts. So this is Duncan's statement of profit or loss for the year ended 31st December 2008. So that is our statement Of course, we know very well that we start with sales. So I'll come here and write sales. But our sales figure is not given as direct. We have different figures because we sell some goods on credit. At the same time, we also have some cash sales. So take you back to the question briefly. We see that in this case, when you look at the question, we have cash sales, yes. So we have some cash sales of how much? We have some cash sales of 14,000. This is good. We have some cash sales of 14,000. But because we have debtors, means that we also have some credit sales. So when I'm coming up with a sales figure, these are some of my workings here. Workings. We need total sales, which equals to cash plus the credit sales. We know very well that now they are telling us, according to the cash summary, that our cash sales, we have 14,000. But do we have the credit sales? The truth is the credit sales are not known. But what are you going to do to come up with these credit sales? You're going to use what we call a trade receivables. Here they are calling it debtors, but let us use trade receivables control account. This is the account you are going to use to find out the credit sales figure, because we have information about the credit, the credit customers. So you can use that information to find out really how much credit sales were made during the period. So I have this account. This is our credit. This is our debit. Of course, trade receivables, all the debtors, these are current assets, don't forget. So I'll come and get the balance brought down at the start, which is 6,300. I'll also get my balance carried down. I enter it on the opposite side, and that is 5,000. Please, I'm getting this from the question. Then during the year, of course, we know very well that during the year, some of our customers paid. Let us try to check that from the question now. Some customers paid. Let's check question. Yeah, debtors paid cash 400, and then still debtors paid through the bank 26,000. Of course, when these debtors pay, their account reduces. So we have to credit because the cash book will be debited. So we have to come here and we credit. So I'll come and say bank. Some of these customers paid through the bank. They paid 26,000. Then others also paid by cash. and through cash we received 400. Through cash we received 400. What else do we have? We try to check. Let's go back to the question. See how much we have. 26 we have entered that. 400 we have entered that. However, some checks we are dishonored. Some checks we are dishonored. So we have a dishonored check from the data. Dishonored checks from data, we have 250. This is on the payment side of your bank summary. So in your data's account or in your receivables account, you have to debit these dishonored checks. So I'll come here and say dishonored checks on the debit. Dishonored checks, that is 250. What else do we have? I don't have the hard copy of the question, so I'll keep referring to the question. What else? 400 we have entered with that. What else? What else? Of course, we have bad dates that we are written off. We have some bad dates that we are written off. So this will be taken to your credit side of the debtors account or the receivables account. Bad dates written off. Of course, the account reduces because now some of the customers are not going to pay. We don't expect to receive this 400. Then you also have credit notes issued. Now, these credit notes issued, of course, these represent return inwards. Return your customers return some of the goods. So you issue what you call a credit what? You issue what we call a credit note. So these are return inwards. The impact of this return inwards on the receivables account, of course, the receivables account is going to reduce. So we shall credit this because you sold goods, but now some of the customers are returning back these goods. So let's go back our working, and then you see how we can enter this also. So we have a bad debt, or we have bad debts. Bad debts, we have 400. We have 400. Then we also have the returns. The returns, we have 1,200. That's it all for the receivables control accounts. What I'm going to do, I'm going to balance off this account. Then find out the balancing figure, sales figure. So this account is going to help us to arrive at the figure for the credit sales made during the year. 26,000 plus 400 plus 400 plus 1,200 plus 5,000. This gives us 33,000. So here we have 33,000. 33,000. When I minus 6,300, also minus 50, we come up with the credit sales figure. Members, our credit sales is 26,450, and that is your balancing figure in this case. So this account of the receivables control account has helped us to arrive at the credit sales figure. So we can now finally get our total sales, which equals to the cash sales of 14,000 plus the credit sales from this account, which is 26,450. When we add these two, we come up with our total sales figure of how much? Of 44,50. That is your total sales figure. So I'll show that sales, I'm getting this from my working one, and we have a total of 40 or 50. That is our sales figure. But of course, we have some sales returns, so I'll say less. Sales returns. Our sales returns is 1,200, 1,200. When you get 450 minus 1,200, you come up with a net sales figure of 39,250. That is our net sales figure. Then of course we have to less the cost of what? The cost of sales. Less the cost of sales. And we know very well that to get the cost of sales figure, we start with our opening inventory. That is your opening. We start with our opening inventory. So we get opening inventory. Here they are calling it stock. It's the same as opening inventory. And according to the balances we have, we see that our opening inventory as at 1st January 2008, we have 4,100. 4,100. Yeah, 4,100. Then of course we shall add the purchases. But the truth is the purchases figure is not also direct. So it's missing. You have to compute that purchases figure as well. So add the purchases. We are going to come up with working 2 to arrive at the purchases figure. We come up with working 2 to arrive at the purchases figure. So I'll just come here. I remove all this because now we need to use this part. Come up with the purchases, come up with our working for purchases. So let's see how we can do this. So some of the information is not always direct. You need to know the techniques you can use, arrive at that missing info, information. So the sales figure was not given to us. Of course, we added the cash sales. We had some information about the trade receivables. So we could get our information about the credit sales by using receivables information. So this is working 2 purchases. So your purchases still equal to the cash plus credit purchases. We need to get the cash purchases plus the credit purchases as well. But now, do we have cash? Let us try to check and see if we have cash. The question, the cash purchases. cash purchases. Do we have any? Let's try to check and see. When we look at the question, we don't have cash purchases, meaning that on credit. So I think we have to use the trade creditors account to come up with our question. So cash purchases, nil. We don't have, and of course we cannot calculate them. There is no information about how you can. According to the information we have, we cannot compute the cash purchases. What we can compute are the credit purchases. So cash purchases, nil, the value is 0. Then credit purchases. These ones are unknown, but we can compute them. Why? Because we have information about the trade creditors, or the trade payables. So I'll use the trade payables control account to arrive at this, to arrive at our credit purchases figure. Trade payables, all the creditors, these are current liabilities. So there is normally what we call, they have a normal credited balance. So I'll come and get that balance brought down. We'll credit that. Balance brought down. How much is the balance brought down for the creditors? This is 2,400. Then the balance carried down, that is 2,500. 2,500, that's what we have. And of course, when you look at the question, I saw a discount received somewhere. So we receive the discount from our suppliers. The discount received, of course, reduces the debtors account balance. So we have to debit that account with the discount received. Discount received, where is that? I have it somewhere here. We have a discount received of 350. Discount received of 350. Then we also have payments to the suppliers. Our trade creditors, we have 18,500. So we can enter this on the debit side of our account, and then we balance it off, find out the credit purchases. So we have a discount received. Discount received. This is 350. Then we also have bank. We made some payments. We paid our suppliers through the bank, and we paid them 18,500. No sales, no purchases, returns. So when we balance off this account, of course, we have to come up with our credit purchases. Now, of course, the debit side is always expected to be bigger. So it's 350 plus 18,500 plus 2,500. And this is 21,350. Even this side should be 21,350 minus 2,400. This gives us our credit purchases figure of credit purchases of 18,950. That is your credit purchases figure. So your total purchases in this case equals to nil because we don't have cash purchases, then plus the credit of 18,950, giving us a total still of 18,950. So that is our credit purchases figure or our total purchases figure, which we can take to our statement of profit or loss here. Here we have 18,950. When we add this, we get how much? When we add our purchases to the opening stock, we get 23,000. Of course, when you look at the question, we see that J. Duncan withdrew some goods from the business for personal use. Those are drawings. We have it somewhere here. Goods withdrawn by J. Duncan for own use. Of course, when J. Duncan takes out some goods or withdraws some goods from the business, of course, our cost of the goods available for sale reduces, or our purchases that are available for sale reduces. So I'll come here and say less goods withdrawn by J. Duncan, less goods withdrawn by J. Duncan, and that is how much? That is 300. Then I'll also less the closing inventory. I'll also less the closing. I'll also less the closing inventory. And how much is our closing inventory? Our closing inventory is how much is the closing inventory? It is 3,200. 3,200. So when we get 23,050 minus the goods withdrawn minus the value of the closing inventory, we come up with a cost of sales figure, which is 19,550. That is the cost of sales figure, which is to be deducted from your net sales up there to come up with what we call the gross profit. Come up with what we call the gross profit. And our gross profit for Duncan in this case is how much? 9,250 minus the cost of sales figure. You come up with 19,700 as your gross profit. On this, of course, we shall have to add the discount received because this is an income. Our discount received is 350. You see this from the trade payables control account, so we add it to our gross profit. When we add the discount received to our gross profit, we come up with a total gross income of 20,250. That's what we have. Then, of course, we shall have to less the expenses. So I'll say less operating expenses. Less the operating expenses. Under the operating expenses, of course, we can start with our bad debts written off. Don't forget. Bad debts written off. Our bad debts written off, that was a 400. That is a 400 from the additional information. Then you have the wages. The wages, we have how much? Wages, we have how much are the wages? Let's check. See how much the wages figure is. Wages. Wages, we have 6,100. Wages, we have 6,100. 6,100. Of course, I'll continue to the next page. Continue with the other expenses. There is rent. We have rent. Rent. According to the information we have, let's try to check on the rent and we see rent. When you look at rent, we have bank 1,400. Do we have under the cash? No. But we have a rent owing as at the end of the period. We have rent owing as well as the rent pre, as well as the rent prepaid. So we have to find out exactly how much rent to take to our statement of profit or loss as the expense. So we need rent, but the figure is not direct. I think I have come up with working. So we have rent. So that will be working number 3. Let us try to find out rent. This is my working page. Working is continued. So rent expense. So I can find out this rent expense for the year by preparing a simple rent account. Of course, in this rent account, we can enter all our information related to rent in this account. The first thing we have, of course, we have some rent prepaid at the start of the periods. We had paid in advance rent in the previous year, so there is an opening balance. Remember, rent prepaid is current assets now. So this is a current asset. Then rent owing. This is the current liability. Don't forget. Let us see how we can come up with this account. Then in our bank, we paid how much? Let us first enter the opening balance for the rent prepaid current asset in this account. So we set balance. This is a prepaid. You have a 200. Then in the bank we paid how much? In the bank summary, there is a payment for rent, which is how much. Let's try to check. Let's see. There is a payment of 1,400 for rent. That is from your bank summary. 1,400. So we debit that to complete double entry. This was a credit in the bank account. So yeah, we complete the double entry by debit. Then we also have rent owing, accrued rent at the end of the year. How much is accrued rent at the end of the year? Let's try to find out that. Accrued rent. That is 250 accrued unpaid at the end of the year, but of course it belongs to the current financial year. That is 250. So let's try also to record that in our account. 250 accrued 50. So when you balance off this, your balancing figure will go to the statement of profit or go to the statement of profit or loss. This is 400 plus 1,400 plus 250. This gives us 1850. So in your statement, profit or loss, we take that as the expense. So rent, we have 1850. That's our rent. Wages, you already have. We have insurance. Insurance. Do you have any additional information on insurance? Let's try to check and see. Insurance. Insurance. Insurance, we have 1,450. That's our insurance, 1,450. No additional adjustments. 1,450. Then what else do we have? We have the loan interest. It is still owing, I think. Not yet paid loan interest. That is 400. I think it's quite confirm. Loan interest. Is it 400? Loan interest. Yeah, it is 300 here. But then they are telling us that there is loan interest owing of 100. So it is 400. To be 400. That is 8% of 5,000 in that case. Loan interest. You want to find out where you get the 400. It is 8%. 5,000. Then what else do we have? The repairs. Let us check on the repairs very fast. It's also electricity somewhere. Repairs. We have a 300 for repairs. Then electricity is 750. Let's put this. Repairs, we have a 300. Then electricity, have 750. Maybe depreciation, you can also compute depreciation. And the depreciation in this case, how can we get depreciation now? Depreciation. We have the depreciation policy of this company. Of course, we don't have the depreciation policy of the company, but what you'll do, you get the difference, get the value of these assets as at the end minus their value as at the start. That is 15,900 minus how much? 15,900 minus 12,600 to come up with the depreciation expense value. The depreciation, we are getting 15,900 because we don't have the depreciation policy. So you just simply get the difference between these two values to come up with your depreciation, which is how much. The first check again. Depreciation. Of course, we also have a machinery that was acquired. We also have a machinery that was acquired during the year. That is, that machinery was acquired at 7,500. It was acquired at 7,500. Okay, so we can come up with a value. There is something we had forgot. That is the value of the machinery that we acquired during the year. That we acquired during the year. So to come up with this, what we are going to do, we show that initially we had 12,600 that we acquired. Anyway, let me just come up with simple working. Let's come up with the working. That will be our working number 4. We see how we can get that depreciation rather than doing it from here. So this is working 4. Depreciation expense. So I'll come up with a machinery account, simple account here. I'll start with the debit balance of 600. That is our opening balance. 600. So we have a total of 600 as our opening balance. Then during the year we acquired machinery of how much? Of 7,500. But by the end of the year, you see that now we have a total value of machinery 15,900. When you balance off this, you see that by the end of the year, the value of your assets, machinery, would have been 20,100. And of course, the value is now 15,900, meaning that during the year, these assets depreciated by 4,200. This is your depreciation expense, 4,200. Those are your operating expenses. You're going to add all these. We transfer the total to the second column, then you come up with our gross profits. We have 4,200 plus 750 plus 300 for repairs plus 400 plus 1450 plus 1850, then plus our wages of 6,100, then plus 400. We come up with a total operating expenses of 15,450. We minus this from our total incomes. Our total incomes, we have 20,050. 20,050. When we minus, we come up with a net profit of 4,600. So Duncan made a profit during that year of 2008. Duncan made a profit of 4,600. Made a profit of 4,600 during that year. So that is Duncan's net profit. Let us see how you can come up with Duncan's balance sheet very fast. And then we close this session. Let us come up with Duncan's balance sheet, and then we see how we can come up with Duncan's balance sheet, or what we call the statement of financial position. That is part C of the question. So we say J. Duncan's statement. Financial position as at 31st December 2008. As at 31st December 2008. Of course, we have a column of cost. Then we have accumulated depreciation, and then the net book value. We have non-current assets. Where we have the machinery. And according to the machinery, we had a balance of 600. But during there, we acquired more machinery worth 7,500, giving us a total cost of 20,100. Of course, according to our previous working, we see that this machinery depreciated by 4,200 during the year. And to get net book value, we get the cost of the asset minus their accumulated depreciation of 4,200. So we get 15,900 as our total book value. That's our total book. That's our total book value. Then you go to the current assets. We go to the current assets. And under the current assets, of course, here we have stock. Stock, the inventory. We have 3,200. We have the data. Stock, the receivables. You have 5,000. Then you have your closing bank balance. Check your bank summary. This was 2,600. Then you have cash. Closing cash balance, still from the cash summary. Here we had 50. No prepayments at the end of the period. So when we add this, come up with how much? With 200 plus 5,000 plus 600. That's 50. This gives us 10. 8, 10. So we add this to our total non-current assets to come up with a total assets figure, which is 26,780. Then, of course, after getting our total assets, we go to equity, or what we call capital. Equity and liabilities. So we have our equity. Under equity, of course, we have our capital balance. At the start, remember your capital balance, I will start from your statement of changes in equity, from your statement of affairs, which we prepared initially. That was 24,100. That was our opening capital from Part A. Of course, Duncan made a net profit. That net profit increases capital. That is 4,600. But you also have to place the drawings. Duncan will do some goods as well as cash from where? From the business. When you check the question, you will see that we have drawings of 9,500 plus the goods that we are withdrawn of 300. Of course, when you add the 300 plus 9,500, you come up with 9,800 total value of the drawings, total amount withdrawn, that is both cash and the goods. This gives you 10,800. When you add up 2,400 plus 4,600 minus 9,800, this gives you 18,900. Then we have our non-current liabilities. Under non-current liabilities, we have our bank loan. That is 8%. Here we have 5,000. Then we have the current liabilities. Under current liabilities, we have what? We have our trade payables, stock with the creditors. Now, according to the question, we have 2,500. Then you have the accruals. Under accruals, we have rent, which is 100. Then plus, no, rent is 250. Then plus the accrued interest of 100, giving us a 3. We add these two, get 2,800. So when we add the current liabilities plus the non-current liabilities plus our equity, how much do we get? We get to 26,750, and this is total equity. Liabilities. How much was the total assets figure? Let's try to check. It was 26,750, and then our total equity and liabilities is 26,750. So this question was all about single entry and incomplete records, and we see that most of the information was not direct. For example, information about the sales, information about the purchases. Most of the information was not direct. Talk about the depreciation of the machinery. So the rent expense to take to the P&L. So you need to know how to arrive at all that missing information for you to be able to come up with your complete set of financial statements. So we are stopping here for today. I'll share the question as well. Make sure that you try to go through the question at the same time. Use this video to see how you can come up with a solution for that question. More still coming, of course. Share the video to your other friends if you believe that they can benefit from it. Don't forget to subscribe to my channel. Thank you. In case you have any questions, you can comment under the video. You can like, you can share. Don't forget to subscribe as well. Thank you for watching. Bye-bye.